Good afternoon and welcome to today's webinar on Basel III and its implications. Our presenter is Dr. Nabil Zaki, and I'll hand you over to him in just a few moments. But first, I just want to run you through some housekeeping rules. It won't take very long at all. This is our agenda for the afternoon. It's five simple things. I'm not going to read that out either because it's very self-explanatory. But I will tell you that the slides that you see today, as well as the entire recording of the webinar, will be available on our SlideShare page and our YouTube channel, respectively. And we will send you an email with the links to this. We just ask that you allow up to a week to be able to do this. At the end of the webinar, a survey box will pop up, and I just ask that you please take time to complete the survey because it helps us know what you've thought about it and how we can improve things. While you listen to Nabil talking, you might have questions about Basel III, and if you look at your control panel, you'll notice a questions box. This is where you type in your question, and at the end of the webinar, Nabil will allocate some time to answer them. So all that remains to say is thank you very much for being here, and I'll hand you over to Dr. Nabil now. Thank you.
Hello, everybody. Before I start, I would love to introduce myself. My name is Nabil Zaki. Actually, I have been in the banking industry for more than 30 years. I started my career in '75, and that was between Chase Manhattan Bank and Merrill Lynch. In terms of private banking, in terms of investment banking, and the dealing room, I was running a book in derivatives between US dollars as well as other currencies. I have been teaching in Asia very heavily, and I'm teaching in one of the universities in the United States in New York. I'm teaching derivatives and corporate finance. It's a pleasure to be with everybody, and of course, as you know, that after my presentation, I am welcoming all your questions about Basel III. To begin with, I would like to touch on a number of things here. Okay, I would like to touch on the sequence of Basel Accords between Basel I and II and III. Basel I actually came to address two important risks, which is basically market risk as well as credit risk. Market risk has been done in a wonderful way, and it's still being treated as such. And we are adopting lots of methodologies that has been recommended by the BIS, Bank for International Settlements in Basel in Switzerland. And we are using for this a number of gadgets, including VAR, value at risk, and the different methodologies for calculating it, including variance covariance, Monte Carlo simulation, a Gauss model, sigma methodologies, and so on. However, the credit risk under Basel II was done in a very unacceptable way, as the credit rating has been associated with a very political concept, whether you are a member of one of the most important organizations, OECD, based in Paris or not. OECD, which is Organization for Economic Development, it's a kind of organization for the rich members and the rich countries and the very well-developed countries. And in this case, if you remember, we were assigning a number of risk weights, like 0 for government risk, like 20% for international banks in these countries, which has not been accepted, particularly after the acquisition of one of the biggest Mexican banks, Banamex, by Citibank. That was, I guess, as far as I remember, August 2001 for $12.5 billion. And immediately in this case came Sandy Weil. He was the chairman of Citibank at this time, and he came up with the concept of what he called economic capital as opposed to regulatory capital, and that was a big push to rectify some of the items for credit risk in Basel II. some of the items in Basel II. Basel II actually addressed two important issues, addressed the credit risk, and here we have to mention that the credit risk under Basel II came up in a very refined way, including the quality of credit risk should be assessed on scientific basis. And the most important thing here is the assessment of what you call probability of default and what you call LGD, or loss given default, which is basically 1 minus recovery ratio. Also, one of the most important risk elements that has been covered by Basel II as well is the operational risk, and that came in handy as well under Basel II. All of a sudden, we found that from 2007 until 2011, as you can see from the slide, a total of almost 400 bank failures in the United States, with a total of 675 billion US dollars, and that costed the US government almost $81 billion. And that led most of the economists and analysts to go and dig for the causes of the financial crisis that occurred in 2007. And BIS has recognized that a key characteristic of the 2007 financial crisis is the inaccurate and ineffective management of what you call liquidity risk. And that prompted, of course, Basel III. Basel III basically is tackling two important things, which are basically more refinements and more fortification and more consolidation of what you call credit risk, and I'm adding another thing, which is liquidity risk. So basically, you are talking about a big sequence here for Basel Accords promulgated by BIS in Switzerland between B1, B2, and B3. One is handling, so it's actually building on one another. You are not actually scrapping one in favor of the other. Actually, Basel III is a new set of rules which was published in response to the recent financial center, which is almost, I would say, it's still dragging, despite the fact that some of the signals are indicating that we are out of it. I doubt it very much. We still have a zero interest rate policy, and according to today's announcement from Janet Yellen, the chairman of the Federal Reserve Bank, we were expecting actually a big change in the month of June, next month, in US interest rates, and apparently we'll still have to do some waiting. The Basel Committee, it's definitely, we have to know, it's an international organization set up by the G10 at the end of 74, but after the crisis in 2000 was extended to G20. This is a little bit of a background about what's happening. Before I dig into Basel III, which is basically, as I mentioned, it's tackling two important elements here: the consolidation and more fortification of the capital proposals, particularly geared towards credit, and as well as new set of issues tackling the liquidity proposals. We have to understand that Basel III is built on Basel II. It's, I would say, theory of building blocks at the end of the day. One of the most important things we have to know, back to Basel II. Basel II, I'm not talking about Basel III. Basel II is basically a number of pillars. Basel II is basically built on three important pillars. Number one, we have to know it's based on regulatory capital. Regulatory capital, which is basically how much regulatory capital I have to set aside for all on as well as off balance sheet products within the balance sheets of the bank. The second one, it's basically supervisory review. We have to understand the supervisory review is the kind of dialogue between the central bank in the local country as well as the commercial banks in this country. We have to understand that supervisory review is crucial, the pillar 2 of Basel II. Why? Because it includes two important things: ICAP as well as SREP. ICAP, which is the Internal Capital Adequacy Assessment process, as well as Supervisory Review Evaluation process. This is very important, how to make sure that the banks, including all its assets, whether I'm talking about on-balance sheet assets, off-balance sheets, including all derivative products, and including whether I'm doing this in the OTC market over the counter or exchange traded markets, derivatives with all the three products of derivatives, swaps, options, futures, as well as all the on-balance sheets, CDOs, bonds, bills discounted, loans, credits, whatever you are talking about, wherever you are working in North America, you are working in Europe, in Asia, you are talking about 6 asset types: equity, bonds, forex, commodities, real estate or property, as well as credit. Whether I'm talking about these assets in cash basis or whether I'm talking about these assets on derivative basis, we have to be able to come up with policies, strategies, procedures to make sure that we have a good risk management policies for them, including VAR limits, including the systems for quantifying the VAR limit, the computed VAR. You are adopting stress testing on it. So in simple words, I would like to flash back a little bit. Okay, I'm actually emanating from here, from pillar 2, about the applicabilities of Basel in general. Basels are applicable in so many phases. It's not only, I would say, a regulation document issued by BIS. No, it's far beyond this. The context is actually applicable to risk management. It's actually applicable to capital management. And capital management is a new science. It's applicable to budgeting. It's applicable to one of the most important things, compliance and performance measurement. If I go back to the capital management here, we have to understand that the capital management is a new science. How to come up with the optimum amount of capital necessary to support the bank's risky assets, or what you want to call it, RWAs, risky weighted assets, be my guest. But basically, the only way for the central bank to know whether the bank is in compliance or not would be reporting. How can I do this? And that's Basel 2. That's pillar 2 of Basel 2, which is very crucial. And this is ICAP. It's becoming one of the most important hot subjects now in the financial markets in Wall Street, which is, again, the internal capital adequacy assessment programs. Another important thing, which is pillar 3. Pillar 3 is called market discipline. Market discipline is basically, I don't have to have a PhD from MIT, from Harvard University, and from NYU or Columbia to understand what kind of balance sheets and what kind of sophisticated balance sheet you have. Everything should be transparent. Market discipline includes 5 important elements: transparency, which is crucial; corporate governance, which is the relationship between the board and the top management, as well as something very important, full disclosure. That's crucial. Full disclosure about all the items. Particularly here, the emphasis is placed on the off-balance sheet, and that's very important. I don't want to memorize you of what happened with Enron, to memorize you of what happened with other big deals and big defaults, that actually the off-balance sheets were the main reason or the main catalyst behind its default. One of the most important items for market discipline here is basically, I would say, the anti-money laundering. So you are talking about, once again, transparency, for disclosure, you are talking about corporate governance, you are talking about environmental issues, you are talking about anti-money laundering. 5 items basically in this element. Back to Basel 3 here. Back to Basel 3. Basel 3 is actually combining between, as I mentioned, capital proposals as well as liquidity proposals. Basel 3 here, it has addressed so many things. In order to understand what are the new elements for Basel 3, we have to understand a little bit of Basel 2. As I mentioned, we are adopting here a theory of building blocks. I am building on Basel 2. Basel 2 actually for the credit risk, it cared so much about a number of elements. It cared so much about a number of elements. How to assess credit risk? Gone are the days I'm assessing credit risk whether you are associated with OECD or not, based in Paris. No, here for credit risk, I'm actually basing my assessment on a number of factors. Number one, which is exposure at default, which is basically how much I have at risk for a credit risky asset. And here we have to differentiate between on and off. If we are talking about on, it would be very easy because you are talking about par plus accrued interest. If you are talking about off balance sheet here, oh no, we have to talk about REE, or what we call risk equivalent exposure. Some people call it different names. It depends where you are. You see, I have worked in Asia for so long between Hong Kong, Singapore, Malaysia area. They call it, for example, loan equivalent risk. Loan equivalent risk. It's the same. In the United States, you call it risk equivalent exposure, loan equivalent risk. But this is done actually through different methodologies. How to come up with the exposure of default. Number two, which is very important, to come up with what you call probability of default. And probability of default became a necessity. It's not a luxury anymore. Probability of default, how much is the probability that this company can default within 1 year? Another one, which is a residual risk. Residual risk, or what you call the scrap risk, is basically the scrap value when the company is default. And 1 minus this residual risk or recovery ratio is what you call LGD, or loss given default. One of the most important things I still have to say, that the central bank is giving you some leeway, or Basel II is giving you some leeway. Whether you are talking about standardized approach, I will give you all the risk weights, but you see the price that you are paying, most probably the regulatory capital would be humongous enough that makes you completely and totally uncompetitive in the market. Or you can actually go to the foundation or advanced. The foundation or advanced, they are called IRB, or internal ratings based. For internal ratings based, by all means, we have more advancement in the systems, or within the internal system, within the organization. And in this case, I can handle some of the factors, and I can take some of the other factors from the central bank. For example, probability of default, I can take it, or recovery ratio, I can take it from the central bank. And finally, if you are very advanced, like some of the banks in Wall Street, like Citibank, JP Morgan, whatever, UBS, Union Bank Swiss, they go for advanced. Unfortunately, most of the banks in the Middle East until now, they are actually sticking to the standardized approach, where the risk weights are extraordinarily high, and definitely it makes the Middle East completely uncompetitive, particularly when it comes to the cost of funds, and when it comes to some products like syndicated loans, where the pricing is usually very low. One of the most important things when I'm talking about credit risk in Basel II, leading to Basel III, is basically what you call expected losses and unexpected losses. Expected losses is basically not a risk. This is part of doing the business. Expected loss, it's actually the normal amount of money I'm losing on accounts receivables, for example. The normal amount of money I'm losing on my portfolio of loans. This is not a risk. The key characteristics of expected losses, is basically, number one, it's not a risk. Number two, it's part of doing the business. Number three, it's already taken care of in reserves and provisioning. Number four, which is very important, I would say it's already implicit and included in the final prices, like a medium-sized business, for example, and they are incurring some losses. In this case, no problem whatsoever. I will make it up on the prices of some other profitable items. Expected losses is basically one of the most important criteria when you are actually coming up with how much is the amount of reserves, how much is the amount of provisioning you have to have, how much is, and this is basically exposure at default multiplied by probability of default multiplied by LGD, which is loss given default, which is, as I mentioned before, 1 minus recovery ratio. Be careful. Technically speaking and mathematically speaking and conceptually speaking, I'm using this expected losses again in one of the most important benchmarks I'm using for credit analysis as a benchmark for credit renewals nowadays, which is RAROC, risk adjustment return on capital. Risk adjustment return on capital. Risk adjustment return on capital is basically adjusted capital over the risk-based capital. Adjusted capital over risk-based capital. Risk-based capital, you have to know, risk-based capital is basically either regulatory capital, which is imposed by Basel 1, Basel 2, Basel 3, or economic capital, whichever is higher. And of course, economic capital, as I mentioned, it has been triggered by so many instances in the market, particularly after the merger of Banamex Bank, one of the biggest banks in Mexico, by Citibank in August 2001. And actually, Citibank bought it for $12.5 billion, and the regulatory capital was less than $200 million, which has been completely unacceptable by the board. That's why they resorted to the concept of EC, economic capital. Economic capital is what? Economic capital is the risk that you see necessary. And accordingly, when I'm talking about the risk that you see necessary, the risk that I see necessary for both on as well as off balance sheet, for all derivative products, OTC, exchange traded, bonds, futures, loans, you name it. And this is the risk that you see after doing your own analysis. So it's not imposed on you. And of course, if the EC is higher than the RC, if you are prudent, you will put it and you will raise the necessary funds. And if you are not prudent, fine. Let me, some banks in the Middle East, for example, particularly in the Gulf, they take a higher charge than 8%, let's say 10%, and some people even taking 12%. This just to be on the safe side, EC, the deviation of the EC, or what you call economic capital, it's called unexpected losses. Unexpected losses is not part of the business. No, unexpected losses is risk. Unexpected losses is risk, and we have to take care of it. And some people call it VAR. Some people call it value at risk. Some people call it value at risk. And this is basically your basis, the unexpected losses, your basis for raising what I call economic capital. As I mentioned, the EC is already covered by provisioning, by reserves. It's not I would say the basis for raising capital. The basis for raising capital and for coming to the stock market, for coming to the equity market, whatever it is the unexpected loss. I would like to know the implications of all of this. I can use it for risk management. I can use it for capital management. As I told you, capital management nowadays is basically the ability to come up with the optimum amount of capital. Not too high, which is actually depressing my return on equity. Not too low, which is making me at loggerheads with the central bank and all the regulators. It actually provides me with a benchmarking for budgeting. What is budgeting? It provides me with a benchmarking for coming up with a proper provisioning policy. Gone are the days provisioning policy is done haphazardly. No, expected losses is the basis for provisioning, particularly when I'm talking about a loan portfolio, a loan portfolio. In here, by all means, we have taken a huge amount of applicabilities of between risk management, capital management, budgeting, performance evaluation, provisioning policy. This is very important. And above all, compliance. You are a good boy at the end of the day. You are a good boy at the end of the day, meaning what? I have my own system that comes up with the assessment of computed VAR. I have a VAR limit, and I am doing stress testing and back testing from time to time, and stress testing assuming the worst case scenarios, whether this is historical, I would call it historical simulation, whether this is actually random variables, I would call it Monte Carlo simulation. And actually, in this case, I would say, oh, the bank is on the right track. The bank is trying to take risks, but they are trying to manage the risks as well. They are not trying to take haphazard risks. They are not trying to take unacceptable risks. This is very crucial as well when you are talking about all of these issues. We talked about Basel 1, Basel 2, and the sequence, and I talked about the importance and the technical assessment of credit risk under Basel 2. We talked about the most important pillars of Basel 2, which is basically the three pillars, either capital or supervisory review or market discipline. And as I mentioned, market discipline includes a number of items. One of them is anti-money laundering, which is a top issue now. Actually, it is of paramount importance, particularly by all the banks, as well as some of the most important organizations worldwide. Basel 3 came. Basel 3, I am fortifying, I'm proving the quality and consistency of regulatory capital, as in front of you on the slide number 11 here. I am increasing the capital requirements. All of this, basically, I'm handling credit risk. All of this, I'm handling credit risk. I'm introducing another important ratio here, which is basically leverage ratio. Leverage ratio. I am addressing something very important, which is procyclicality. Procyclicality. Something very important, we have to understand that in Basel III rules and regulations, we have to understand that under the existing tier 1, under the existing rules, tier 1 is basically it's basically 2%, 2.5%. Now it's up from 2.5% to 4.5%. More rules. I am actually trying to introduce measures to limit counterparty credit risk. All of this is basically, as I mentioned, consolidation, fortification of the credit risk, and short-term and medium-term quantitative liquidity ratios. Will come back to this later. But basically, I am actually increasing and improving the quality of bank capital to be admitted. I'm increasing the minimum regulatory ratios. I'm introducing for the first time capital buffers to be added to the minima. I am reviewing the treatment of single and certain regulatory capital components, and that's very important, particularly like for example, I would say the minority interest capital, significant equity investment in banks, deferred tax assets. I'm talking about finance insurance companies. I'm talking about some of the hybrid equity instruments. Like what? Like convertible preferreds. All of this, I am trying to limit. I'm trying to retreat it in another way. I am actually introducing an anti-cyclical capital buffers to avoid excessive increases in banks' risk position in the expansive phases of the cycle. Thus, I'm trying to avoid the negative consequences that emerged in the recession phases. I'm introducing additional capital requirements. This is for counterparty risk, particularly in relation to the off-balance sheet activities. You're talking about letters of credits, letters of guarantees, bid bonds, performance bonds, derivatives, and I would like to reiterate here, okay, I'm not only talking about OTC derivative, I'm talking about OTC and derivative financial products, options, and for OTC, particularly more requirements, particularly for exotic options like barrier options, like knock in, knock out, like Asian options, like rainbow options, and all of that. I'm introducing a leverage ratio, which is basically a ratio between capital and non-risk weighted total assets. I'm introducing, of course, the risk, liquidity risk becoming extremely important. As we mentioned at the very beginning, liquidity risk is the main reason behind the last crisis in 2007. Banks were awash with liquidity, but they didn't want to give it out. Why? I'm scared of what's happening. I don't want another crisis. You see, banks have come down in terms of capitalization by almost 85 to 90%. People were scared. People were panicking. The introduction of risk measurement and monitoring provisions in the short term, in this case, they called it liquidity coverage ratio. And in the midterm, they called it NSFR, which is the net stable funding ratio. The net stable funding ratio. I would like to reiterate some of the most important things here, as I mentioned, capital requirements. Here, you see, Basel III is not touching so much on the last two pillars of Basel II, which is basically supervisory review or basically market discipline. But they are actually trying to enhance the ways or the methodologies I'm using to come up with the amount of RC or regulatory capitals. Here in Basel III, in capital requirements, I have three important elements, which is basically capital ratios, more capital ratios. Okay, basically, I'm enhancing them. So I'm putting more restrictions on tier 1, more restrictions on tier 1 plus tier 2, more restrictions on the total. So the total is no longer will be 8. Most probably it would be 10 to 10.5%. 10 to 10.5%. If we notice here, the risk-based capital ratios, tier 1, Basel III requires banks to hold 4.5% of common equity. Of course, after my restrictions about the definitions of common equity, not everything would be included here. I have some reservations about the definitions, about some of the most important conceptual terms included in the common equity. All this coming from 2%. 6% of capital must be tier 1. 6% of capital must be tier 1. If I go to total tier 1 increased will be increased from 4% to 6%. Total capital, total minimum capital requirement, it will remain at 8% subject to the new capital buffers. However, if I am combining with buffers, the total risk would be almost 10.5% because as we are going to see here, capital buffers, I have two kinds of capital buffers. I have what I call conservation buffer, and I have what I call counter-cyclical buffer. Conservation buffer, I will use it when I'm stressed, in times of stress. Basically, a financial crisis, I am in recession, and that is going to be 2.5% of core tier 1, and it has to be met by only common stock equity, not preferred stock, no convertibles. How about counter-cyclical buffer? Counter-cyclical buffer, that's a range of up to 25%, but I will leave it to the discretion of the national regulator. I will not impose myself on this. As I mentioned here, between the 8% and the 2.5, the capital buffers, the total risk-based capital will be amounting to 10.5% of risk-weighted assets. I just want to mention something here. As I mentioned, 3 important things you have to memorize here, or you have to concentrate on. When I'm talking about capital requirements, I'm talking about my definition of capital, what should be included in the common stock, my capital ratios, the enhancements of the capital ratios, as well as the capital buffers. All of this with a time schedule. All of this with a time schedule. As I mentioned here, in addition to the rise in Tier 1 capital, a new series of capital buffers should be introduced to further increase the minimum requirements. The conservation that requires the banks to hold above the 8%, a further core Tier 1 capital over and a further 2.5%, of course, of the core Tier 1 capital over and above the new 4.5% level. And as I mentioned to you, the counter-cyclical buffer is a little bit optional, and it's left to the discretion and judgment of the central bank. It will only be in effect when there is an excess of credit growth that results in a system-wide build-up of risk in any given country, and definitely it will operate as an extension of capital conservation buffer. All of this timing, of course, we started already. We started already in some cases, but the capital conservation and counter-cyclical will be actually offered as far as next year in January 16. It will be gradual until 2019 in increments of almost 0.625 of risk-weighted assets. One of the most important things I would love to talk about is basically liquidity. Liquidity can be actually defined in so many ways. And liquidity, I just want to mention something before I'm touching on the LCR as well as the NSFR. Liquidity is defined as basically the ability of the company, the ability of the bank to come up with the right cash to satisfy short-term obligations, But it can be defined in another way. It can be defined the ability of converting a current asset or a marketable security as normal in a balance sheet of a bank into cash, and I can use this cash somewhere else. One of the most important things I have to mention about liquidity is a state. Liquidity is a state. It's like an 85-year-old guy with good health. Why you are healthy like this? Because I was leading a healthy life all my life. I was not smoking. I was not taking drugs. I was not excessively drinking. I was sleeping well. Why you have good liquidity position? Because I'm managing other risks properly. It's a state. That's why people refer to liquidity risk as a consequential risk. Liquidity is becoming one of the most important, hottest topics in Wall Street to be identified and to be quantified, to be measured and to be managed. And liquidity risk is one of the most important items now that can represent a drag on the balance sheet and on the profit and loss of the company. Here, we came up with what we call liquidity coverage ratios. Liquidity coverage ratio, or LCR, this is actually a short-term liquidity metric, and it requires banks to maintain high quality, unencumbered assets in excess of their stressed cash flow over 30-day time. We have to understand that liquidity can be triggered by so many issues. That's why one of the most important things when you are studying liquidity, you have to be capable of coming up with a list of all the things that can actually induce some shortages in liquidity and trigger some problems in your liquidity in the bank. The fact that I don't have enough high quality assets, the fact that I don't have a non-marketable assets, the fact that I have an assets which are very hard to price, the fact that I can have a huge amount of encumbered assets. That's why liquidity coverage ratios here, it requires banks to maintain high quality, unencumbered, no lien on it. There is no lien on it, on these assets, in excess of, be careful, as the slide is saying, stressed cash flows. Stressed cash flows, this is the key. I'm not talking about any kind of cash flows. That means you have to apply stress testing for the 30-day time. This is already in application for some banks, and I've seen it for some of the American and European and Asian banks. I'm applying in a new one, but this is actually postponed a little bit at a later time, which is called net stable funding ratio. Net stable funding ratio, it's actually very important to promote medium and long-term funding of the assets and the activities of the bank over, of course, the horizon that we all know about it, which is basically convened by most of the analysts, by banks, and by the market participants as a one-year horizon. This is a structural funding metric, a structural funding metric. One of the most important thing in the implications of Basel III in general, or Basel Accords in general, of course, it makes me, if I am in compliance with, of course, it puts a huge amount of pressure on my cost of funds, and the cost of funds is the key for any bank. It makes you competitive or uncompetitive. It's either a make or break. It's either a make or break. It's either you can make it. Lots of banks have gone sour because of the huge amount of cost of funds. If you remember Republic National Bank of New York in New York during those days in the 70s and 80s by Edmond Safra, the bank now is part of, it used to be part of Marine Midland Bank, after this part of HSBC. The cost of funds killed it. The high cost of funds killed it. It's definitely, as an implications, I would like to stress here that the cost of funds is getting higher. It's a challenge for banks in terms of implications, but at the end of the day, we want to produce a safer international banking community. I would like to come up to the final points here regarding my presentation. Basel is very crucial, and Basel is here to stay. I'm expecting more Basels as we are proceeding. You see, Robert Rubin in his book, In an Uncertain World, he said, as long as we are working, we are making mistakes. Okay, and if you notice, all the way during the last 25, 30 years, every year we have something. All the way since 1995, on February 26, 1995, Baring Brothers Singapore, to Metal Jessel Shaft, to the Asian crisis in 1997, to 2003, the meltdown of the stock market in the United States, to September 11 and the implications of it, to the 2000s. Every year we have something major. As long as we are working, we still have to fine-tune our rules and regulations in order to produce a safer environment for both depositors, investors, as well as banks. Thank you very much. I am actually welcoming your questions, and if there are any questions, I can see some questions are coming. I can see some questions are coming. I have a question here, very important. The question is saying, are Basel Accords only applicable on banks or companies? I love the question. Actually, in an attempt to produce a healthy investment environment, Basel Accords, either 1, 2, and 3, these are regulatory documents produced by BIS, Bank for International Settlements. You are talking about banks. So it's actually a regulation document on banks. But at the end of the day, banks are dealing with corporates. At the end of the day, banks are dealing with individuals. At the end of the day, banks are dealing with governments. So if I have a big mega company, like Unilever, like McDonald's, like Airbus. These companies are humongous, and they are actually everywhere. They are spreading their activities everywhere. In simple words, the document is applicable in a direct way on banks, on an indirect way on corporates as well as governments. Everybody has to adopt sound and safe risk management. Otherwise, I would be accused as a bank that I am dealing with a lousy guy, that he doesn't know how to manage the risk, although he's actually operating in more than maybe 50 countries, maybe 100 countries, and I would be blamed for it. At the end of the day, I would be required as a bank to set aside a higher amount of regulatory capital, and that will be a burden on me, increasing my cost of capital. So the answer to your question, sir, yes, directly on banks, indirectly on everybody else. Any more questions? Thank you very much. All the best of luck to everybody.